Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're breaking down the company that sits at the center of nearly every swipe, tap, and click you make, Visa Inc., ticker V.
And I'm Lana Chen. Visa is one of those companies that people think they understand, but the actual business model surprises a lot of folks. They don't lend money, they don't issue cards, they run the rails.
That's the key insight right there. Visa is essentially a toll booth on global commerce, and today we're going to walk through exactly how wide that toll booth is, what the numbers look like, and whether the street thinks there's still room to run. Let's get into it. So Visa was founded back in 1958, headquartered in San Francisco, and today it's a nearly $600 billion company. At its core, Visa operates VisaNet, a transaction processing network that handles authorization, clearing, and settlement for payment transactions across more than 200 countries and territories.
And the scale is staggering. We're talking 257.5 billion transactions processed annually, handling roughly $14.2 trillion in total payments volume. With about 30,000 employees, Visa generates that kind of throughput with a remarkably lean operation.
Revenue comes from a few buckets: transaction processing fees, service fees charged to financial institutions, licensing the Visa brand, and increasingly value-added services. That last piece is really interesting because VAS revenue hit $10.9 billion in fiscal 2025, growing at 24% year over year.
The moat here is textbook network effects. Visa has roughly 4.5 billion cards issued globally and commands about 70% of U.S. purchase volume. More merchants accept Visa because consumers carry it, and more consumers carry it because merchants accept it. That flywheel is incredibly difficult to replicate.
And the why now for this episode is that Visa's sitting at a really interesting crossroads. You've got AI-powered agentic commerce opening new revenue streams, stablecoin volume surging after the Genius Act, the 2026 Olympics and FIFA World Cup creating payment volume tailwinds. But you've also got DOJ antitrust litigation and the Credit Card Competition Act creating some legitimate headwinds.
It's a company with an undeniable competitive position facing the most regulatory scrutiny it's seen in years. That tension is exactly what makes it worth a deep dive right now.
Leading Visa through all of this is Ryan McInerney, who took over as CEO in February 2023. He's been with the company since 2013, but his background is really interesting. He started at McKinsey as a consultant, then moved to JP Morgan Chase, where he actually launched their first mobile banking product.
And he didn't just dabble in banking. He eventually ran JP Morgan's entire consumer banking division, overseeing more than 75,000 employees. So he brings deep fintech and consumer technology expertise. His reputation is as a forward-thinking operator who understands digital transformation at scale.
3 years into the CEO role, the market seems to view him favorably. He's been leaning hard into value-added services and positioning Visa for the next generation of digital payments.
All right, let's dig into the financials. Visa is trading at around $302.55 per share, putting the market cap at roughly $578 billion. The trailing PE sits at 28.66, and the forward PE drops to 22.92, which tells you the market is pricing in meaningful earnings growth ahead.
And the revenue trajectory backs that up, right?
It does. Trailing 12-month revenue comes in at $41.4 billion. Looking at the quarterly progression, you can see the steady climb. Q2 fiscal 2025 was $9.6 billion, Q3 was $10.3 billion, Q4 was $10.6 billion, and Q1 fiscal 2026 came in at $10.9 billion. That's a clean upward trend.
What about profitability? Because Visa's margins are kind of legendary.
They really are. Gross margin sits at 97.78%. And yes, that's not a typo. Operating margin is 66.98%. When you're running a technology network and you're not lending money or taking credit risk, the unit economics are extraordinary.
Free cash flow.
Operating cash flow is $24.4 billion, and free cash flow is $22.9 billion. The conversion rate from operating cash flow to free cash flow is extremely high, which speaks to low capital intensity. On the balance sheet, Visa holds about $16.4 billion in cash against $21.2 billion in total debt, a very manageable position for a company generating this kind of cash.
Earnings per share.
Trailing EPS is $10.66. The most recent quarter, Q1 fiscal 2026, came in at $3.17, beating estimates on both revenue and earnings. Overall, Visa's financial health is strong. This is a high-margin, capital-light business with consistent double-digit growth and massive cash generation.
So what's the analyst community saying about all this?
The consensus is solidly buy. Out of 36 analysts covering Visa, 27 rated a buy, 8 have it at hold, and just 1 has a sell. The average price target is $388.44, which implies about 28% upside from current levels.
That's a pretty wide gap between where it's trading and where analysts think it should be.
It is, and the range tells a story too. The low target is $323, still above the current price, and the high is $450. Morgan Stanley has an overweight rating with a $411 target, Macquarie is at overweight with $410, and RBC Capital has it at outperform with $395.
And the last earnings report was a beat?
Double beat. Q1 fiscal 2026 came in with revenue of $10.9 billion and EPS of $3.17, both above consensus. Management guided for low double-digit revenue growth and high end of low double-digit EPS growth for the full fiscal year. Nothing flashy, but steady and confident.
All right, let's do bull and bear. I'll take the bull case. First, the AI opportunity is real, and it's happening now. Visa is working with over 100 partners globally on agentic commerce, which is essentially AI agents conducting transactions autonomously. That's a brand new revenue stream that didn't exist 2 years ago.
That's a fair point. The infrastructure advantage is real. If AI agents need payment rails, Visa's network is already there.
Second, stablecoins. After the Genius Act passed, Visa jumped on it. They're already processing $3.7 billion in stablecoin volume with a $2.5 billion annualized monthly run rate. If crypto-backed payments scale, Visa is positioned to capture a meaningful share.
And the VAS business.
That's number 3. Value-added services at $10.9 billion, growing 24%. That's not a side project anymore. It's becoming a core profit driver that reduces Visa's dependence on pure transaction volume.
Now for the bear case. The elephant in the room is regulation. The DOJ antitrust lawsuit targets Visa's debit market dominance and tokenization practices. If the Credit Card Competition Act passes, it could allow merchants to route transactions through alternative networks, which would directly compress Visa's pricing power.
How significant is that risk?
Potentially very significant. Interchange fees are the foundational revenue driver. Any structural compression there hits the entire business model. Beyond that, you're seeing alternative payment networks gain traction internationally. India's UPI processes billions of transactions outside the Visa and MasterCard ecosystem entirely. If that model spreads to other emerging markets, Visa's addressable market could shrink.
What about valuation?
At nearly 29 times trailing earnings and 15 times sales, Visa is priced for continued excellence. Any stumble in execution or acceleration in regulatory action could lead to a meaningful re-rating lower. The insider selling doesn't help the optics either. 0 insider purchases in the last 6 months against 12 sales, totaling roughly $30 million.
Let's put Visa in context with its peers. The obvious comparison is MasterCard, which trades at a PE of about 30.5 and a PS of 14.1. Very similar valuations, very similar businesses. MasterCard is essentially Visa's mirror image on the other side of the duopoly.
Then you have American Express at a PE of 19 and change with a PS of just 2.5. The key difference is that Amex operates a closed-loop model. They issue cards and extend credit directly. That means more revenue per transaction, but also more risk, which is why the market assigns a lower multiple.
And PayPal?
PayPal is the outlier at a PE of just 8.3 and a PS under 2. Revenue growth around 7% versus Visa's double digits. PayPal's operational challenges and weak 2026 guidance have crushed the multiple. It's a very different risk-reward profile than the Visa-MasterCard duopoly.
Quick look at the options market. The put-call ratio for Visa is sitting at around 0.72, which leans modestly bullish.
I-fee percentile is at 35, so the market isn't pricing in major volatility near term. Call open interest clusters around the 320 to 350 strikes, while put support is concentrated in the 280 to 300 range. The options market seems comfortable with the current price level, but is positioning for some upside through the summer.
Makes sense given the Olympics and World Cup catalysts coming up in the back half of the year. On the insider front, it's been a pretty one-sided picture. 0 insider purchases over the last 6 months, but 12 sales, including CEO McInerney selling roughly $18 million worth, and President Rajat Taneja selling about $10 million.
Context matters here, though. These are executives with substantial stock-based compensation at a $600 billion company. Selling for diversification or tax planning is extremely common. It's not necessarily a bearish signal, but the complete absence of insider buying is worth noting when combined with a nearly 29 times earnings multiple.
Let's flag the key risks one more time. Number 1 is regulation. The DOJ lawsuit and the Credit Card Competition Act could fundamentally alter Visa's pricing power. Number 2 is international competition from alternative payment networks that bypass the traditional card infrastructure entirely.
Number 3 is data sovereignty requirements in regions like the EU and India that increase compliance costs and could fragment Visa's global network advantage. And number 4 is the broader structural risk of processing commoditization. As the technology becomes more standardized, the premium Visa commands could gradually erode.
Key metrics to watch going forward.
Watch cross-border volume growth, VS revenue as a percentage of total revenue, and any developments on the regulatory front. The next catalyst is Q2 fiscal 2026 earnings, which should give us a read on whether the Olympics tailwind is materializing.
All right, let's bring it home. Visa is the definition of a quality business. Near-perfect margins, a wide moat, consistent growth, and massive cash generation. The street sees 28% upside, and the growth catalysts from AI commerce, stablecoins, and VAS are legitimate.
But quality comes at a price. At 29 times earnings, there's not a lot of margin for error, and the regulatory environment is the most challenging it's been in years. The key metric to watch is cross-border volume growth. That's the highest margin segment and the best indicator of whether Visa's global toll booth is still widening.
We're going to close with a quote from Warren Buffett, who said, "In business, I look for economic castles protected by unbreachable moats."
If there's a company that fits that description, Visa is on the short list. The question is whether the moat is as unbreachable as it once was, or whether regulation and innovation are starting to chip away at the walls.
Love that perspective. That's going to do it for episode 65 of Charged Alpha, our deep dive into Visa Inc., ticker V. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.